Good evening, everyone. We wait for another 3 minutes, then I will start my sharing session. So before that, you all can ask any questions or chit chat in the chat box below. Thanks for coming, and I hope you all can learn something today. Okay, so hi, good evening, everyone. My name is Ming. I'm a full-time trader for past 7 years, and I trade stocks, index, forex, and also there's a technical problem. Okay, so today I will be sharing about. Back to my introduction about myself. So I'm a full-time trader for past 7 years, and now in the education part. So I trade in forex, indices, stocks, and also cryptocurrency. And I also use automated trading strategies like grid trading in the market to produce a consistent profit in the market. I have shared some automated strategies like grid trading in my weekly trading class. So make sure you all follow me, and I hope to see you all in the grid trading lesson. So today I will be talking about beginner's trading guide about options trading. Last week I talked about how to deploy a put option, how to long a put option. So today I will be introduce you all about call option selling. So we do a sell calls in this sharing session. All right. So since there are many beginners here, so I will still going to refresh about for you all about what is option. So option actually is a leveraging tool for you all to like magnify your profits and returns in the market. It allows you to trade in any market condition with any asset. Normally, we use options to trade stocks and also ETF. So as you can see, options, actually there are different types of like option strategies in the market. Whether to deploy in the bull trend, which is uptrend, bear trend, which is downtrend, and also sideways market. So usually if we like trading a spot market, we buy a stock, we need to wait the market to go up to profit. And when we short the market, we need to wait the stock to go down to profit. And options actually, we can also profit from sideways market. Sometimes a stock will stagnant in the range for certain period, like maybe like comes from weeks to months, right? So how can we like maximize this trading opportunity and maximize the profit when the market is in the sideways? Because when we hold a stock and the market goes through a sideways, sometimes we don't know how long the sideways lasts. So by using options, by selling options, we can actually profit from this sideways market. So I will explain how we do it later. So please make sure you all follow me closely. So let's do a recap about what is options. So basically there are two buyers and also two sellers in options. So for the buyer, they always have the right to buy or to sell. So for the call buyer, they have the right to buy. And for put buyers, they have the right to sell. And for the buyers, they always have the limited risk. So for those who are new here, maybe you all can be very confused about this, but make sure you all can like go back to see the replay, or maybe in the near future I will do this option trading guide, basic option trading guide again. So now I just explained the basic options. But like for the buyers, the risk is always limited. Remember, just take this in your mind. And then today I will be focused on talking about sellers, call sellers. So sellers always have the obligation. What is obligation? If the call buyers have the right to buy or not, call buyers have the right to buy or not. So as the options expire, they can choose to buy or not. But for call sellers, they are obliged to sell. So if the call buyers, they want to actually buy at the expiry date, they actually want to buy, the call sellers have to sell it. They can't, they have the obligation. And for the put sellers, they have the obligations to buy from the put buyers. And call buyers, you are looking for the market the price to go up. You earn from the uptrend of the market. While for the call sellers, you don't want the market to go up. You want to either it sideways or go down, because for call sellers, you actually want to earn the premium. And the maximum risk of the sellers is unlimited in in option trading. So just remember, for the options in buyers in options, they always have a limited risk. And for the sellers in option trading, they always have unlimited risk. You just remember this. Buyers will always pay the premium, and the maximum profit of the sellers will be the premium, maximum profit of it. And for the buyers, the limited risk is also the premium they pay. It means that they only lose the premium they paid only at max. Whereas for sellers in options, their risk is unlimited. So just remember this. All right. So this about options. I mean, in summary, for what I have shared for the past few weeks. So today I will be focused about sellers, call sellers, and call sellers are obliged to sell because the call buyers have the right to buy. So we as a call seller, their counterparts, we are obliged to sell to them. So introduction to call option selling. I will share about what is naked call. Okay. Naked call actually is you sell the options without owning a stock. And when you do a naked call, by selling a naked call, you actually focus to collect the premium. Remember what I said? For call buyer, you are looking the market to goes up, right? Then you profit from the uptrend of the market. Whereas for the call sellers, you don't want the price to go up. You want the price to stay sideways or even go down. Then your profit will be premium. Your maximum profit will be the premium paid by the call buyer. So we are the counterpart of the call buyer. So for I repeat again, for the call buyer, you have limited risk, which is the premium you pay. And the premium you pay is paid to the call seller. And the sellers will receive the premium. And the maximum profit of the sellers will be the premium paid by the call buyer. However, for call buyers, the returns is unlimited and the risk is limited. But for the call sellers, we aim to earn the premium only. And our risk actually is unlimited. However, we can limit our risk, and which is called covered call, and I will explain in next few slides. So we just back to this naked call. So we sell options, we sell a naked call, we do a naked call, we sell a naked call options without owning the stock. So and we aim to collect the premium. We don't want to earn like the call buyers, we can earn a lot by the price that went up. But for the sell options, we want the price to stay sideways and goes down. So if the stock price rises above the strike price, then we as the sellers have the obligation to buy from the buyers, to buy the shares to fulfill our obligation. So potentially incurring the significant losses as it has unlimited loss. So let us get back again, and this time I will give an examples for you all to have better memory of it, better understanding of it. So first, you sell a call option like XYZ, any name, with $60 strike price, expiring in 1 month and earn a $1 premium per share. So if the stock price stays below 60, you keep the premium, right? Because we as a seller, we don't want the price to go up. We want the price to stay sideways or goes down. Because we as a counterpart of the call buyer always want the price to go up to earn. Then call buyers call buyers deal a contract with us call seller. Now we become a call seller and we aim to earn their premium only. All right. So we don't want the price to ramp up above the strike price. So for now, the call option of stock XYZ is strike price 60 and expiring in 1 month and earn a $1 premium per share. So if the stock price stays below 60, we keep the premium. Always remember, we want to earn the premium from the call buyers. However, if the strike price is 60 and the price went up to 70, then how much you lose? So actually, we lose $10 per share, right? And one contract, sorry, if you buy one contract is 100 shares. So 10 times 100, if you buy one contract, you lose 1,000. However, still remember that you had received the $1 premium beforehand. So actually, you lose $900 in this case. And why the risk is unlimited? Because the stock price can continuously go up. What if the stock price then above $80? Then you'll be incurred like 2,900, 1,900, and then goes up again, and then goes up again. Your losses keep increasing. So that's why selling naked cost actually is very dangerous. The risk is unlimited. However, the maximum you earn is the call buyer's premium only. So you all must remember, sellers, sometimes you can hear many people lose a lot in options. It's because they are doing naked cost. They are selling naked cost, which is very dangerous, which is not encouraged to do this. But maybe if you're very confident in it, you all can go to it. But I advise you all not to do a naked call unless you are very confident about you can earn this premium. All right. So first, I will share with you all why you use naked call. It has high potential premium income. So by selling the cost, we aim to earn premium. So if the stock can go sideways for a long time and below your strike price, yeah, you can actually keep getting the premium. And it's only suitable for experienced traders, like I said. So I advise for beginners, or maybe like for me, like even though I like years of trading experience, I won't even touch this naked cost because it is very dangerous. So, but everyone got their own style, everyone got their own strategy. So please make sure you all have the plan if you all want to use naked cost in selling call options. All right. So for those who are confident that the stock price won't go up, you all can open a sell call. But for me, it's still very dangerous. So avoid it at all costs. If you all still insist, so good luck for you all, and God bless. Okay. So yeah, I explained about naked sell cost. So the risk is unlimited, and your maximum risk is also the premium only. The risk reward is not good, and it requires you to have a significant margin in your account to cover potential loss. Because just now I explained the loss can be unlimited. What if one day the stock surges for more than 30%, 40%? You can face a massive loss, right? Okay, so today I will be focused on sharing with you all what is covered cost. So you can think like covered cost is like you want to take a profit of the stock, but let's say if you had a Tesla shares at $100, then you wanted to sell it at 300. This is your initial trading or investing plan. So sometimes it takes like for 2 to 3 years from 100 to 300, right? Then and your target is only 300. You wanted to sell it at 300 when you buy this stock. So how can we maximize our profit? Sometimes it can be sideways, like at 100 to 200 within this for few years. So how can we maximize our income? So back to covered cost. I explained it what is covered cost first. So I own this share, like minimum 100 shares, one contract. and I agree to sell them at the strike price. Like I said just now, you have owned a Tesla stock at 100 and you aim to sell at 300. But in between, maybe it takes years, sideways or anything. So how can we benefit? How can we use options to maximize our return? By collecting premium. So while waiting for the price from 100 to 300 to achieve our target, actually we can keep selling the cost at maybe 300. Then as long as the price below the strike price, we can keep on getting the premium. So if it takes 2 to 3 years for the Tesla stock, like from 100 to 300, then we can earn this premium like for a long time, because sometimes the market can be sideways for really long. Then if it's sideways for really long, then when we open the option, we can still get new some profits out of the market. And since we are targeting this 300, so this is a win-win situation for us. So that is the difference between selling naked and also selling covered call. Because one, you don't own the stock. When you don't own a stock, you don't have the stock to cover to sell, right? You don't have the stock to sell. So you will face a massive losses. However, for covered calls, you need to own the stocks first. You need to own the stock first. I repeat, just like I said, you own 100 shares of the Tesla at 100, then you aim for the stock to hit 300. However, there's potential the price will sideways for a very long time. So you keep selling the 300 call option. As long as the price is below the 300, you can keep on getting the premium and keep on milking the profit. Then when it really hits $300, you will sell the stock at 300. Then your total profit will be your increment of the stock from 100 to 300, the $200 per share profit plus the premium you collected. So this is really a win-win situation in this market. So this is the best. This is why selling covered calls always have the highest winning rate in the market, and many people do that. Many big players do that, like Warren Buffett. They do this in the long run, so they can keep on milk the profit from the market. So I will these are examples I mentioned just now. So I will just share it again since in order for you all to like get a better understanding. So I write it out. So in selling covered calls, you own 100 of shares of stock ABC at $50 per share. Then you sell a call option with a strike price of 55. Since you bought a share, 100 shares at $50, then you wanted to sell it at $55. So in between, you can actually sell the call option at a strike price of 55. So as long as the price stay below this 55 or sideways, you can, in this case, this is the 2 premium per share, you can keep earn this premium. Like maybe 1 month, this month you can earn $2. If you get it $2 and the price still didn't go past this 55 strike price, then you can keep on buying again, repeat buying this premium again. So you will slowly milk the profits out of the option of this stock option. Like $2, if you get $2 out of $50, you get how many percent? Right? That's a lot, almost near 5%. So here's the example. If the stock stays below $55, you keep the share because you didn't hit the strike price, and you don't have to sell your stocks up. You'll keep the share price and the premium. So if you do a sell call, you are hoping that the market won't go through your $55. And still remember that I said selling covered cost actually is like taking profit. So you bought this stock at 50, you aim to sell at $55. While waiting this, you can sell a call to get extra profits from the market. So as long as you didn't pass through $55, you keep the share at the premium. And if the price rise above $55, the buyers will exercise the option. Because call buyers, they will exercise the option when the price moves above the strike price. And you have to have the obligation as a call seller, you have the obligation to sell to him. So you already, since you sell the call option, you already get the premium, but missing out on the gain above $55. But remember, actually you still earn because your initial plan is selling this $50 share to $55. When you hit $55, okay, I'm out. All right, this is your initial trading plan. So it's good for those who have a like solid plan. Like I want to sell this stock at this level. So when it hits, you won't like change your TP. You won't change your take profit level. So I make a summary like why use covered cost. So we want to generate additional income while owning the stock, and we reduce the effective cost of holding the stock, because sometimes as long as we didn't TP, we didn't take profit, while we wait for the price like from A to B, like from just now $50 to $55, while we wait, it can be sideways like for maybe few months or weeks. Then while waiting, we can get extra income, and our portfolio will be more liquid since we will have additional income. And suitable for the stock, we believe in long term. And only for me personally, I only look for good fundamental stocks only. Because in long term, actually the good fundamental stocks will either sideways or goes up to hit my TP. So I have more confidence to add or hold this stock while waiting for the price to hit my strike price, which is my TP. And the risk, it can be like it has limited upside, because just now, for example, like $50 to $55 is your initial plan, $55. So above this 55, you already kept your returns at this $55, which is 10%. So above this $55, the capital gain of this stock is none of your business. So we can't predict the market. So sometimes we have to have a solid plan to know our TP levels when we buy this stock, right? No one can predict the future. It depends on your strategy. If you want some maybe portfolio of you is long for long term, some of the portfolio of you is like making passive income. Some of the portfolio of you is like using automated trading strategies like rig trading. And some of your portfolio can be like very short-term trading to generate more income. So it really depends. So options is actually one of the tools that helps you to leverage your income in the market. And you need to learn more in the market too, always. So market is never endless learning places. So today I will share with you all, since you all aiming this stock to hit a certain TP, why not you all open the selling covered cost to generate additional income? Yes, for this limited upside, actually because you kept the upside already. So if the price went up further, there's no choice but it's same as the spot market. If you didn't sell it, you'll never realize the profit. The profit is not yours. Yeah, limited upside, if the stock price skyrockets, the profit is kept at the strike price, which is we intended to sell at this price. We have the solid plan, right? We have the solid plan to sell at, like, from we bought it at 50, we want to sell it at 55. This is our plan. So we follow the plan and execute this and use selling call options. Most of the people, like traders or maybe beginners or maybe newbies, less inexperienced one, when they bought a stock, even though they didn't trade using options, they bought a spot market stock when, like, from 50 to 50 to 60, they intended to sell at 60. However, sometimes they will just maybe wait, say, no, I won't sell at 60, it can go up more. Then it went over like maybe 80, they still won't sell 90, and then suddenly it dropped back to 50. And then in the end, they didn't realize any profits. And this is the most of the problems of inexperienced traders. So remember, a part of portfolio of you need to always take profits, because you never know when the market downturns or go out or go opposite direction of yours. All right. So selling covered calls is one of the best strategies for those who own a stock in long term and wanted to keep it at a higher price. So here, the risk you could lose money if the stock price falls significantly. It means this is like for the sell puts only, right? For those who do a naked call, they will face a stock price lose a lot when the price goes the other way around, goes up, right? When you sell a call, when the price you do a naked call, selling a naked call, when the price keeps going up, you will lose lots of money. However, when you do a covered call, your risk is safe because you own the stock and just want to keep it at it. So I think there's an error here. The stock price goes up significantly. All right, sorry. So here, this is the summary of the aspect of covered calls and naked calls. And ownership of the stock, the difference between the covered calls and the naked calls is you own the stock or do not own the stock. The naked call is very dangerous. As you say, you don't own the stock, and when the price keeps going out, shoot a lot, then you'll face a lot of losses. However, for the covered calls, if the price shoot a lot, you just take profit of it because you own the stock at a low price. So that's the difference. And for the risk, the limited at a stock decline, and the risk, like I say, the naked call is very dangerous. And for the cover cost, your reward will be the premium and the limited upside, but it's still the upside. Like just now, my example, you own the stock at $50, you wanted to sell it at $55. So you actually earn the $5 plus the premium per share. And for the naked cost, you earn the premium only. You didn't own any stock, so you won't earn any capital appreciation from the stock, and you face a lot more risk. So this is the dangers of selling naked calls. Remember, here we just focus on covered calls. I have to explain the difference between covered and naked calls. So I had introduced about this, what is covered call and naked call. So to sell covered calls is actually much more safer because you own a stock and you cover the stock. That's why it's called covered call, and naked call is very dangerous. The risk is unlimited and you earn premium only. So until here, any questions? I hope you all understand what the difference between it and how do we benefit from this selling cost. hopefully you all have an idea on about this cover cost and major cost. And don't feel shy to ask me any questions. I try my best to share with you all. Okay. All right. All right. Before I get to the next slide, we just remember selling cover cost is very safe compared to major cost. Your risk is maximum the take profit limit and the premium, and your risk is limited because you have the stock at a low price and wanted to keep it. So you have to think that cover cost is for you to take profit at a certain price while generate income, passive income. So how do we do a selling cover cost? How do we do from A to B to C? So selling cover cost is to generate additional income for our stock investment portfolio. We own the stock, we want to generate extra income. We want to have a passive income in the market. Because the difference is when you own the stock in spot, when you didn't sell it, you don't have additional income. So by doing this selling cost, you can generate additional income, which is a win-win situation. And many big players, like while waiting for your capital gains, while waiting for the take profit to get your capital gains, you actually can get also dividends and option premium. So total, your returns will be higher compared to invest a spot, like you buy a stock and wait on it, right? You buy a stock, you wait. Maybe it took 3 years from 100 to 300, right? You only earn maybe if the stock has dividends, you take 3 years to earn 100 to 300 and maybe some dividends. Whereas for selling call options, when you sell the stock and you're aiming for 300, if you take 3 years, you keep on selling this call, then you'll keep making the profit out of the market, and then you have a lot of like income, like to maybe you can do whatever you want to reinvest, or maybe at least there is a passive income in your portfolio. So in the long run, since it got profit coming in through your portfolio, so your psychological mental will be more stable and won't do stupid stuff. Because in the market, when your psychology is not stable, you tend to do many wrong decisions. When it's the time for you to act, you sell it. This is how impatient traders always sell low, buy high. Yeah. So we need to avoid that. For the strategies, but we always find a good, fundamentally strong company, and you need to own at least 100 shares. And in the short term, while waiting for the stock going sideways down or moving up slowly, we sell the out of the money call options to collect premium. So we want to choose those call options with out of the money, and then we sell one contract call option for every 100 shares owned. So remember, for the one contract of the option, we own 100 shares. So at least we need to own 100 shares of the stock. So actually for call options, we actually need some capital, because we need to own 100 shares of stocks first. Then only we can only open one contract to do this selling covered cost. And then you keep collect the premium and repeat the process every maybe 30 to 45 days when the options expired or near expired, to generate additional income, stream of income. let us dive to examples again. Then what happens when we selling the carbon cost? So here I will give an example that you open one contract of selling carbon cost, like 300 at $300 strike price of McDonald's at 5.35 premium per share. So how much do you need to open one covered call, to sell one covered call? Remember, you need to own, if one contract, you need to own at least 100 of shares. So if the share, like MCB shares remains $300 below, the options will expire worthless and you will keep the premium. So as a call seller, our maximum profit will be the premium. For selling covered calls, it will be the return will be the premium plus the capital gain, because we own the stock at the lower price and we wait it to hit PP while taking the premium as the additional income. So if the McDonald's shares go above 300, the call option is in the money. So if in the money, we have to sell when it expired. We are obligated to sell our 100 shares at $300. And our capital gain is limited since we kept it at $300. But we earn the premium. So for those who scared that what we do is we share this, we got this 100 shares, we already sold the 100 shares. We can always buy back the 100 shares, right? We buy these stocks like maybe McDonald's at 100, then like maybe 200. When we hit 300, we sell a sell call. We do a sell call at 300. Okay, we do a sell call at 300. So when the price is moving from 200 to 300, while it remains below the 300, we take the profit at $5.35 premium per share. So if we hit 300, we realize the 50% return, which is $100 per share return. We sell our stock to the buyer. Then we get the cash. Then we can actually use the cash to buy back the 100 shares again. So sounds good, right? We can do this always. So we own these 100 shares of McDonald's in my portfolio, and the current, but to own this portfolio McDonald's shares at 296, we actually need to buy at least 100. So we need $29,600 to buy this stock. And yeah, the current trading price is 296, and we buy it at this 100 shares at 296. So we notice that the market will move sideways and have a bearish bias. Well, this is long-term stocks. I mean, maybe can short-term, you are looking at like short-term downtrend or short-term correction. However, you want all these stocks you want to buy is actually have a good fundamentals long-term stock. So we do this sell type of call. You have the what? Yeah, the confidence to hold it for a long run. This is just near a correction, and you don't want to sell because you might sell it low and spike out further, and you can't buy it back. So you open this selling covered call, and you buy this initially at 296, 100 shares, and you have the your technical analysis or your view is very biased, and you are noticing that the market is actually going sideways. So you decide to like sell one contract of McDonald's at February $297, call at 5.35. So what is the premium collected? As I said, the premium collected will be the maximum premium. So the premium will be 5.35 times 100, which is 535. So the returns will be like this one will be like around more than 1 month expiry date. Usually I will buy more than 1 month or 2 months expiry date options. It depends on the strategy. So in this case, I will count it at 40 days to expire. So I collected $535 if it didn't hit 297. It stays below it. So my returns will be 1.8% divide sorry, my returns will be 535 divided by the 100 shares I bought, which is at 296, which is 29600. So as long as the price didn't move up to 297, so we can keep on receive this 1.8% return in 40 days. So in this case, actually 296 to 297 is very close. I just give a maybe idea of it. So if you get 40 plus days, 1.8% in 40 plus days, actually your potential return is 16.2% a year, which times 9 around 40 days times 9, 360 days. So while you're waiting from a stock price from A to B, from 296 to 297, this very close, let's say like from 296 to 300, actually you can get a better return while waiting the price to hit the 50. So it can actually lower your risk in the market because you got more additional income to buffer your portfolio. This is a very win-win situation. So the downside for most of the beginners, maybe for selling cost, I think you need to buy a good stock, and the good stock usually cost a lot, right? Because you need to at least buy 100 shares. So but still, this is a knowledge, and we need to earn it. So one day we can actually hit that as a beginner. We can slowly develop, and when your capital becomes very big, you need the safe investment. So most of the big players I met, they actually really do this self-covered course, and they've been getting a good life. As for the stock section, as I said, we only choose the fundamentally strong stocks that will rise in the long run. Ideally, Dow Jones 30 stocks. And why I don't suggest this Nasdaq, because actually it is just personal view, because actually for the technology stock, it can be very cyclical. And if you want to consider Dow Jones 30 stock or index, or maybe SPX index ETF, yeah, but it really depends on what you have faith with. And I say I will choose those stocks with strong economic modes, maybe like Palantir, Adobe, Microsoft. Personally, I won't choose Apple. It depends on your view, because I don't understand much about the stock, and that's why I won't choose it, because I'm afraid, yeah, the EV, yeah, just choose the stock that you are sure that long term it will went up. So mostly it's like in the SPX 500, and to be safe, the index, the ETF will be the best choice for you in long term to generate additional income. And we want to avoid those biotech, pharmaceutical companies, and also commodities, because the commodities can be very cyclical, like gold, like petrol, like those metals, all those very commodities is very unpredictable. So we have to avoid that. We want a stock that is very stable, and maybe insurance, like very stable. Yeah. So we just pick the top 1% quality stock to do this selling cover cost. in order to have a better win rate, and we can hold it for a long run. We can do it, generate this passive income steadily. And we also avoid selling calls during earnings, because when before earnings, it can actually spike up or spike down. We want to avoid those volatility. But I'm not stopping if anyone want to try it, because everyone's risk appetite is very different. For me, I had actually experienced a big loss before, so I know if you want to success in trading, you need a very consistent and steady strategy to fight for a long run. It's like a marathon for me. So we want to find a stock by using technical analysis that it started to move sideways or trending down. I mean, you want to buy a stock like long term, like 4 to 5 months, you want to go up, but now it's maybe the trending down is like maybe just a correction, a big correction, or maybe correction on sideways market. Then you sell this option, the IV, implied volatility. Examples for me, I will choose like around 40 to 50 to be ideal. And this is just my personal preference. And we sell the calls at 1 to 2 strike price out of the money. Because the call buyers want to buy because if the call buyers out of the money, they will lose the money. So we as the sellers, we benefit when the call option is out of the money. It's just the counterpart of the sellers. We as the buyer, we are versus this buyer. And the delta I will choose is around 0.4 to 0.5, not too extreme. And I will choose like maybe around 1 month before expiry date. So for this delta, this expiration date, actually it really depends on your strategies, what you want. And I just give a guideline for you all. So for those who want to try out, maybe you all can do a psychology demo trading and see how the market moves, and then you slowly learn something over the time. For those who are rich enough, maybe because sometimes we need to put the real money to get the psychology, to get the psychology feel in the market. Because if you do a demo trading, sometimes the psychology will affect you and you can win a lot. But in the real market, when that's involved in money, sometimes you can make a difference. Sometimes you can make a wrong decision, because the emotions will control you. You always need to control your emotions when you are trading. You always want to make sure that you are stable in the market, emotionally stable. All right. So this is the risk profile of selling one contract of McDonald's at 297, cost at 5.35. So I explained this I think many times over past 2 weeks. So we just do a fast refreshment. We always start with plotting the chart with strike price 297, and the break-even price will be the 5.35, because we receive this 5.35 premium, and we don't want the price to go up. So there was extra $5.35 as a buffer, and when it passes beyond this 302.35, we will actually lose. And our limited return will be 535, and our risk will be unlimited. However, this is for naked cost, selling naked cost. So for selling cover cost, actually we have stock at a lower price, so we sell it at the strike price, which is not a problem. All right. So next I will talk about so till now I'm not sure you all follow me on. Still follow me. I hope you all can ask me questions, or maybe I'm too fast, or any questions you all can just stop me. So if no people ask questions, okay, so I will continue share, because there's not a lot of time. So So next I will talk about how to exit the covered calls. So there will be only three possible outcomes. The short calls expired, out of the money, and expiration worthless. So as a call seller, we wanted the calls to become out of the money, become worthless, because the call buyer will lose and we earn the premium. So we can actually also buy to close the short calls before 1 week before the expiration. Then the call buyers exercise the option in the money and you sell your shares at the strike price when you hit it. That's the three possible outcomes. So let's discuss about the scenario of each three. So first, we will focus on the scenario that when the stock price falls below or below strike price, with the two strikes, more than two strikes out of the money, 1 week before the expiration. So we let the expiration, we let it expire worthless, and our maximum profits will be the premium. So if the price fall, always remember the strike price is our TP, our take profit. In selling covered calls, we wanted to take profit for our stock, but while waiting to take profit, we want to earn the premium. So as long as the stock price didn't hit the strike price, which is our target profit, so we can earn the maximum profit. And it happens when it's out of the money. All right. Then after that, after it expired, when the option is expired, actually we can continue, since it didn't hit our TP, then we can continue to open another call option with around, maybe this is just my preference, like one strike out of the money, 35 to 30, 40 days to expiration. Then we open another call option again, like to continue continue generate the income. So for scenario two, just now the scenario is it didn't hit the strike price. So for this scenario two, it's near the strike price. Near the strike price, it can be like at the money, out of the money, or in the money, or around there. So 1 week before expiration, what can we do? We can continue to roll the call options to a new short call. So what it means by roll? So we close our existing short call, then we open another new call option. Just now the scenario is fall below the strike price. We let it expire. While expired is still below the strike price. While in scenario two, because we don't know if we're at the money, out of the money, or in the money, we can choose to roll the short call. Means that we didn't wait for the expiration date, we close the short call, and then we open a new one. All right, so it's around one strike out of the money, 35 to 40 days to expiration. So for this parameters, like what strike you use, I always use +1 2 only, ±1 2. It really depends on your strategy. So for you have to, like, maybe for some new beginners can be very confusing about this small like that, but you will just try it to open yourself, then you'll slowly understand. And for the scenario three, when the price goes above the strike price, what it means by goes above the strike price, it means it hit our TP, target profit. So the option is deep in the money and get exercised by the call buyer. So when we sell this out, we keep the option. When we started to sell the call, we already keep the premium. But the strike price hit, right? The strike price hit when the market is both above strike price. So we have to sell our 100 shares to the buyer, and the cash will be credited into our account. Then what we can do is we use the money to buy the shares, 100 shares again, and we continue to use this to sell the call. The sell opens the new call option, one strike of the money 35 to 40 days to expiration. So this is how we keep on roll every month to get the additional income. Actually, it's not that hard. So maybe you all need to like try yourself to have a better understanding. So step to roll the short call is buy to close the original for one because we don't want to wait for the market to expire and we are not sure if will maybe get exercise or not. And the price is very near the strike price, so we can continue to close and offer another longer expiration short call. Then we buy to close again and then sell to open again the new short call, and we keep repeat it based on the different scenario. So today I share about the advantage and the risk of the covered calls. And for advantages, this is just summary. We can keep on collect our premium as extra money income, maybe some 2 to 3%. You can make it 2 to 3% per month. It's equivalent to 30% to 35% a year. And if you own a good stock, it actually gives a dividend. And this can actually significantly increase your portfolio liquidity and also increase your additional income, right? So you have better cash holding in the hand, and in the long run, you can outperform the market. So this is a strategy that can maybe generate like I think maybe 20% to 30% to be very conservative stock, even if you move sideways or down in the short term. So it also reduces the cost of owning the underlying stocks because you keep on getting additional income. All right. And yeah, selling cover calls can be used to exit the price. I always say, if you intended to sell at those price, you just sell the cover calls at those levels while waiting for the price to hit the stock price. You can actually keep on generate the income. So this is how you beat the market. You are not waiting for the stocks from A to B, and it can take years. And by doing selling cover calls, you can actually keep on getting a passive income. There's not much stocks that can like strategies that can getting passive income, other than getting dividends. Grid trading, automated trading strategy. The next one will be this selling covered calls. So the upside capital gains are capped in selling covered calls, and the downside of holding this one is for naked. Correct. So this is the summary of the day, and thanks for your joining. So remember, selling cover calls is always a best idea for you to own a good fundamental stock and earn the passive income in the long run. So just remember this. So any questions you all actually can add me. Or if you all don't have Usmart app, for the Hong Kong users, you all can use my QR code for at the left side, and the middle one will be the Singapore app, or add me at the WeCom, which is one of the WeChat. Can use WeChat to add me. And any questions you all can ask me now, because now the time is almost up. And I hope to see you all, and then I hope to see you all, and I'm very interested to motivated to share you all more strategies about how to trading. I also did share quick trading strategies, automated trading strategies. I also did share how to become a profitable trader. in the market, like the basic idea of technical analysis, the psychology, how to invest. I will keep on sharing this beginners class, beginners friendly class, and I hope to see you all in the upcoming sharing session. Thanks for everyone for coming here today. Any questions you all can also ask me. I actually opened a Telegram group, but there is only I think one member inside and it's inactive. By the time if you all have a lot of people join, maybe we can share more about the views in the market there. Or any question you all can ask me too in the groups. So I think time is up, and thanks for everyone's coming. Any questions you all still can like PM me or join the group, and any questions you all can ask me, and I wish you all the best in the trading market. Right? My name is Mei. Good night and have a nice day. So before I end, I will show this with a disclaimer. Have a nice day, everyone. Take good care.